Keith, we were just talking about some of the recovery that we're seeing today, some of that broadening out of this rally, but the concentration that we've been talking about in tech, that did expose some of the cracks in this market. So for you looking ahead, is that a risk to the bull run?
Well, absolutely. And thanks for having me. We've done a lot of work around this subject. It's been a core of some of our transactions here over the past 12 months. As we've been inching out of large cap growth, especially the spaces within that space that have really exploded when it comes to demand for the shares and the move up in some of those names. We've looked at it a couple of ways, but the dislocation has really been the most concerning part as far as how we look at valuations of those few names, particularly Mag 7, to use the overused mantra, but names that have been levered to the AI trade. And when it comes to our allocation and how we allocate capital across the world, we've moved away from preferred habitat of years of large cap growth because we feel like that dislocation in valuation really made some of those names, particularly those that were up the most, very vulnerable to any type of shocks that might cause any concern or debate around the ramp of demand, as well as the supply that can meet that demand. And we saw both of those kind of collapse yesterday with DeepSeek. We didn't anticipate that particularly, but just felt like that vulnerability presented a risk that we didn't want to really expose our clients to coming into year-end.
So, Keith, and how critical are the earnings reports that we're going to be getting over the next several days, just in terms of whether or not it's going to calm some of that fear that certainly has been introduced to the market at this point?
We think it's incredibly critical to the path of stocks going forward, particularly for the first half of this year. As we combine not only, now we have questions or concerns or at least a debate around how quickly and how competitive the landscape will be going forward. We also have high rates, even though we had a pullback yesterday. 4.5% on a 10-year puts increasing pressure on equity valuations, particularly those with the highest duration, which are these names that have the highest ramp in the further out years of any DCF, discount cash flow model. So as we're looking at this earnings season, you can do a couple of things. It can disappoint, and the expected growth of 11% for the fourth quarter, 14% for 2025, could really add yet another risk to that valuation of the S&P 500, which is driven largely by, again, those larger, higher growth, technology-oriented companies. Or it could outperform, which landing above 11% on the fourth quarter and having guidance that ticks the 14% expected from a bottom-up standpoint, even higher, perhaps in the mid to higher teens, that will give a little more breathing room to stocks as that valuation doesn't have to continue to carry the day, and earnings can, on a more widespread basis, push that the indexes higher and give a little more leeway to upward momentum to continue through the first half of 2025. So we think this earnings period is extremely critical in setting the stage for 2025 and how much pressure valuations could potentially be under in the first half.
And Keith, I want to pick up on that valuation point. Like you said, tech is very expensive. That's been driven by AI, but the ROI is a little uncertain right now. So while the AI trade is certainly real, it's also speculative. So how do you position yourself within a speculative environment to really balance those risk rewards?
We've been doing just that, just balancing the risk reward by making sure we're diversified across our U.S. equity exposure. Now we're more balanced we bought more in the top 200 value. We're also not biased towards U.S. growth at all at this moment. We're more balanced for growth to value. Still prefer U.S. over international, but we've just had to spread our risk. And we feel like, and you see from an earnings standpoint, if you dig into the S&P 500 and what's driving the growth in the S&P to the 14% expected growth in 2025, it's been the rest of the 493 stocks. We're finally getting contribution from other space, and you kind of see that with the banks as they had a really robust earnings period earlier, a couple of weeks ago, and we're getting into some of the more meat and potatoes, traditional industrial type of names that have reported decent earnings growth and have contributions that have taken a lot of the pressure off of the Mag 7. And we feel like that should reward those stocks and spread out some of the performance that we've seen just concentrated in just a few stocks.
All right, Keith, great insight. Thanks so much for taking the time to join us here this morning.